All right, guys, we're back again with another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Today we have Nick Elder. We're here today. We're going to talk about some multifamily stuff. Another investor who made the transition. I guess we'll get into it if you're 100% out of the single family. Now I'm doing some multifamily stuff. We'll talk about why. But before we get started in the interview, Nick, let the audience know a little bit about your background and how you got started in real estate.
Yeah, so definitely appreciate you having me here. Really excited to have this conversation. My career began outside of real estate. I was in the healthcare industry right out of college, started in pharmaceutical sales, did a number of different ventures in the healthcare world for the following, 5 years or so. And then August 2021, 2022, got laid off from my pharmaceutical sales job. I had real estate investing sort of as a side hustle at the time. But when I got laid off, I said, that's the end of that. No longer going to be in healthcare, not going to do pharmaceutical sales. Very passionate about real estate, love real estate. And so I really went all in on my real estate venture. And so fast forward to today, I'm on the investor relations team where I raise a lot of the capital at Ironton Capital. We've raised about 50 million, a little over 50 million in the last about year and a couple months across all of our different funds. And then I also have my other company with two other business partners, and we do some single family fix and flips and smaller syndication deals. So I've got two companies going on here at once. Love them both. Love the projects that we're embarking on, and I love partnering up with our limited partners to expand their wealth.
Mm. Yeah, that's great. It's amazing. I'm listening to your story, how you something that you thought was bad turned into something good, and now you are on your way, onward and upward, doing, I guess, what you're passionate about. And why are you passionate for real estate investing?
That's a great question. I started my journey in 2019. I bought a house, single family, 3-bed, 3-bath in Denver. I bought it, moved into it, and I rented out the other 2 bedrooms to roommates and effectively eliminated my rent. And so at the same time, I increased my income and I was saving all this money. And I just kind of really start to feel the power of growing your wealth through real estate, even doing something as simple as like a house hack, like I just highlighted.
Yeah.
I really started to recognize the potential. And it was something I didn't even know that I had until I started doing it. And from there, I just kind of really just started to see the possibilities. I bought another house hack and I was like, man, this is great. And then we went through the massive appreciation party in Denver. I saw my net worth, expand by about triple digits just from the appreciation party we had in the market. But I realized it wasn't scalable, and I saw other people in multifamily doing what they were doing, and just started to recognize I invested in some syndications myself, saw the power of it, saw what it was doing to my wealth, and the passion stemmed from that and wanting to be the guy that is doing that for others in our limited partners. And so just kind of this passion came out of nowhere, and 5 years later, I'm still feeling it, and I know it's what I want to do for the rest of my life. And the
That's
passion
awesome.
is really just helping others grow their wealth through real estate in ways that they didn't even know was available to them.
Yeah, it's amazing. I kind of made the same pivot 3.5 years ago to multifamily, still doing some fix and flips. So I have similar to same models, some fix and flips here in New Jersey, where I've been investing the last 24 years, and multifamily in the Southeast, units from 40 to 150 units. And I'm pretty sure you ran across the same thing. Like, man, why didn't I start off with this, right? Why did I have to do this fix and flip stuff and deal with all these contractors and all this other stuff? Fix and flips are great, right? It's very transactional. To have a blend of both is important, I think, for diversity. But the multifamily, right, is nothing like that. And then after being a multifamily 3.5 years, a buddy of mine do storage. And he's like, I get to do this without dealing with any tenants. It's this square box with electricity, no toilets or anything. And well, that's great, if you're, just looking at the money part of it, but what we do more is for an impact to the community, providing housing for low income and stuff. But yeah, there's a lot of shiny squirrels out there. Just got to dig in your heels and go deep on what you're doing. So let's talk about the multifamily stuff. What part of the US are you doing that strategy, and what deal size are you focusing on?
Yeah. Yeah, so at Ironton Capital, we've got our National Diversified Fund. It's a blend of new development and value add projects that go all the way from a single family home development project in Denver to 300 plus units in luxury class A and workforce housing. So our motto is diversification, and so we're really capturing a blend of mostly multifamily, but various different strategies and asset classes in the Northwest, Southeast, in Florida, South Carolina, Georgia, Alabama, and then up in the Northwest that I just highlighted. We have a couple projects in Michigan, and then we have several here in Denver. So we're really, kind of in all over the place, but in high population growth, tax advantaged states is where we really focus. And I personally have a 25 unit under contract that I'm working through the due diligence on in Fayetteville, Arkansas right now. So really love that market in the Northwest Arkansas region. But yeah, we're just, in short, kind of a long answer to a short question. We're really kind of all over the place, all over the US, but all over the place as far as, what we like to do in multifamily, deal size, et cetera. So we like diversification. As much as we can diversify for our limited partners, the better.
Yeah, I mean, you mentioned something that how do you guys handle logistics being that spread out, right? So you said, Southeast, Northeast, I believe you said Northeast, or you said North Midwest. What did you say? Michigan, right?
Yeah. Michigan is kind of an outlier state that we're involved in, and then mostly in the Southeast and then the Northwest. So at Ironton, we invest as a limited partner with sponsors who we know have a great track record. So we team up with developers and operators in, say, the Southeast, like Florida and South Carolina, who know the market. They've got expert knowledge. They've got the systems in place. Maybe they're vertically integrated. They have a really good process, and they've got a strong track record. We invest with them as a limited partner. We'll invest anywhere from like $1 million to $3 million in their project. And then we go out to our investors and raise our capital. So a lot of these sponsors that we work with, it's hard to get into their deals unless you're a repeat investor or you're writing a check of $1 million or more. And a lot of people just don't have those capabilities. And so that's what we offer at Ironton Capital. We then go to our investors and we'll raise capital at a minimum of maybe 25 to 50,000, and we can give them access to these institutional quality deals in these top competing markets.
And you guys are going as an LP as opposed to GP?
Yeah, we have some co-GP projects, but for the most part, we're taking a large LP position in a project.
Yep. And you're probably LP in the capital stack as just senior lender than you guys. There's no mezzanine involved with that?
Yeah, correct. We're on the common equity side, so we haven't really taken a pref equity position yet, but we're looking at it.
Okay, awesome. What do you see, I guess, how is the market affecting your business? Because interest rates are high. I mean, on the buy side, I know there's some turmoil there. What are some of the things you guys experience on the multifamily side and the market you're in?
Yeah, we're saying no to a lot more deals. I mean, the reality is, I'm sure you saw, is that 2 years ago, you can get into a deal with max leverage. You could put 25, 30% down and the DCR pencils out on cheaper agency financing. Now you're having to come to the table with, maybe 40, 45% sometimes. And the returns just aren't there. You're looking at an IRR a couple of years ago in the mid 20s, and now you're looking at maybe upper teens on the deal level IRR, and it's just not as attractive anymore.
Yeah.
So we're seeing that a lot. We've got really good relationships. That's why we're doing a lot more on the new development side. So we're developing new apartment complexes, or we have some residential townhome development projects locally. That's where we're seeing more of the opportunities right now, as opposed to the value add projects that we had saw 2 years ago that just aren't penciling out nowadays.
Yeah, that makes sense. We're kind of doing the same thing on the residential side, the new construction. I mean, it's not worth rehabbing these old houses and finding problem after problem and digging into the bottom line, and you get it to the table and the seller wants to negotiate you down. So the new construction does make sense. What about on how long is the hold? Is it a 5 to 7 year play? Is it something short term? What does that look like?
Yeah, the whole period has kind of changed as the environment's changed. Some of the projects we're investing in, for example, we're investing in a fund of a fund. So we're investing in one company that's going out and building, say, 8 to 12 apartment complexes. And so when we blend that with our national diversified fund, we're typically projecting maybe a 4 to 6 year hold period. But some of these smaller development projects we're finding are more in the tune of 2 to 3 years. But I think when you average out the entire fund that we have, we're looking at more of like a 4 to 6 year hold period. We'd love to get out of these projects sooner, but the reality of the market is we don't know what the next 3 to 5 years looks like.
Yeah.
Be in a lower interest rate environment, but a lot of our partners, they're projecting a little bit more on the 5 to 7 year time period just to plan for the worst of the worst as far as the economy goes.
Are you having investors like push back because of the timeline, or this market, the growth market is pretty much slow on both ends. On the acquisition side, investors sitting on the sideline. Are you having investors that are still looking to jump into deals, or is it a little slow raising capital? I mean, because I know from a few other guys who do this, they're having some challenge with the investors having the confidence in the market, because where the market at, particularly on a deal if it doesn't have permanent financing. Like if it's not 90% occupied or more, then they're not looking to invest into deals that has bridge debt. So are you guys seeing any struggles on that front, where maybe the sponsor who's running the deal might have some bridge debt with a CapEx play to remodel, raise rents, and yada, yada, yada?
Yeah, that's a great question. I would say things have slowed down a little bit, especially with our diversified growth fund that we have. I think it's more, at least in my conversations with investors, it's not necessarily, there's a few of them that are maybe concerned about the economy and they're not moving forward. A lot of our investors, naturally, they've got large portfolios in Denver, and they're selling those properties to invest with us. And so for that reason, that slowed down our capital raising period just because of the nature of who we work with as an investor. But no doubt, I mean, talking to other operators in the area, or not just in the area, but just in connections that I have, the capital raising has stalled. Interestingly enough, we just launched a medium-term income fund, and we raised about $10 million for that in a span of 2 to 3 weeks. But it's an income fund. It's not growth. So we're able to offer quarterly dividends to investors right away. So I think maybe we're seeing more investors that are, maybe their goals are pivoting a little bit more to protecting them in something such as an income fund in the event that we go into a recession, versus locking their capital up for a 3 to 5 or maybe even 6 year period.
Yeah, it's a debt market, right? I was just on a debate the other day, debt versus equity, and we won. It was 58% to 42%. Is that the right math? I think that's the right math. So yeah, we won 58-42, and they said debt over equity in this market. I mean, the win, if you're investing in debt, the win is to your back.
Yep.
I think it's a strategic play that you guys did with the income fund, because people are looking for, of course, if it's profitable to pay those distributions, people are looking for a set distribution that they can count on versus a 6 pref, 8 pref, and 22% IRR. Or you're going to get, people want to know, they'll take less, but they want to know this is something realistic they can get. So that's the market we're in, and that's what I was saying earlier. This is going to be the market for the next 3 years, right? We don't know when it's going to come back, and the higher the cap rate, the lower the purchase price. So it's good for us as buyers, right? But at the same time, there's challenges on the other end that you have in the market, raising capital and everything else, getting deals that's less than 90% occupied. You got to kiss a lot of frogs to find the right deal. So your buy box, I know the state test you're in, the number of units, what's the smallest to the largest that you guys would take down? Because I know you said you got a 25 unit under contract.
Yeah.
Talk about that a little bit.
Yeah, so for my personal portfolio with my 2 business partners outside of Ironton Capital, we're looking for sub 50 units, and we really like the Northwest Arkansas market. Once we take this deal down, we'll probably continue to look for more deals there. We like sub 50 units. It's right within our price range. This 25 unit is at a $2.05 million purchase price. So it's not a large raise. The challenging component of that is that it needs to be significantly under market rent to have a strong IRR on something that small. And this project fits that buy box. But we like sub 50 units, probably under 4 million. And when you're getting to that point, you're not dealing with a lot of competition that I've seen, at least. You're not competing with the institutional firms or anything like that. You're also probably even eliminating a good chunk of the other 80% of competition. And we like self-managed properties as well. As we're going through this one, we're finding that there's a lot of opportunities where the previous owner was maybe self-managing the property. That's where we typically find these distressed assets. Maybe they're willing to sell or finance it, or we can assume the debt, or maybe it's just a function of, they were, for example, this owner, like he hasn't increased his rents because he wants to keep it 100% occupied and he doesn't want to have any vacancy just for the sake of his own income, right? And so for that reason, you're looking at an apartment complex that's $500 under the market. So we like that, and I think we'll probably continue to hone in on opportunities such as that.
That's awesome. When you can structure, especially in this market where there's a lot of creative financing opportunities, and you can get the seller, hey, you don't want to trigger a big tax event. Why don't you do some strategic financing, and we'll give you a chunk of cash up front. And you can do deals that are less than 90% occupied when you do find something like that, right? Because now you have permanent financing in place for 3 to 5 years, whatever you structure with the seller. You can execute your CapEx plan, your occupancy plan, get it up there, get permanent financing to take them out. There's no prepayment penalty. You usually can get it for something like a 6%, 7% with the owner. So those are very creative. I like that you mentioned that, and you will find a lot of that on a smaller deal. So, if you're able to get in there and do some creative stuff with the smaller deals, is great. Plus, it gives you the ability to sell out those smaller deals, right? It's easier to sell a 25, 40 unit versus 150 unit, right? You
absolutely
get it in, stabilize, fix it up, boom, you're out of there. So,
Yeah, we launched a workforce housing fund in Denver, and we partnered with a local operator, and a lot of the deals he was getting was seller financing. And I mean, I don't know what seller would agree to some of these terms. I think they'd be in quite a bind, but one of them we got at 91% loan to value, 8 years interest only at 3.5%, no prepayment penalty.
Yeah, that's somebody who just didn't want to deal with the headache, right? They wanted just a little bit of cash flow. They didn't want to deal with the headache anymore. They can make more money off of a note that they can count on versus probably making a little bit more from them self-managing and dealing with the headaches.
You're exactly right. Yeah. Not most owners are going to be like, well, that doesn't make that much sense, but you could be dealing with an owner that's just, it's such a huge headache, like you just outlined, and he wants to get rid of it. And he could probably get equal, if not better, cash flow just by being the financing partner on the deal. And so, this kind of goes back to finding the right partners to partner with, because, this individual is just highly skilled at finding really good deals and being creative. And for that reason, we're leveraging his expertise, going out to our investors, and we raised about $1.5 million for that fund. And just by, who we know and partnering with the right folks. And that's the value that I think, we can really offer to our partners at Ironton Capital.
That's awesome, man. This is a really great conversation. If you guys want to find more information about Nick and his opportunities have available, give them the LinkedIn, Nick, that they can reach out to you and check you out.
Yeah, that's perfect.
No, the LinkedIn site.
Oh yeah, it's Nick
Elder Real Estate, right?
Yeah, that's it. Yep.
Nick Elder Real Estate. Check him out on LinkedIn. Get a conversation with them. Talk a little bit more about his business model. Yeah, I like having real estate investors that are actively involved on a show. Of course, you have to do your own due diligence, who you're dealing with. It's good to see that, because there's a lot of people who are promoters, right? Who are just raising capital or doing things and they're not actually doing the deal, right? So, and a lot of people don't understand the capital stack. Things that they're investing is important. So you have the senior lien debt that's there. Sometimes sponsors and operators will go out and get mezzanine financing, or they'll do a syndication to fill up the gap from the senior lien to whatever it is to close. But more than likely, you'll see, and if you are an investor, you definitely look at the capital stack, right? If there's any mezzanine debt, it's important because you'll be in third position, right? And how secure are you if the operator doesn't execute? What a lot of people don't understand is asset management is the most challenging part of the business, right? Finding a deal, getting a good price, evaluating it, all that sexy. We close, we pop the bottles, everybody's excited. But the real work comes with asset management, right? Can that sponsor execute on what they said they can do? So you definitely want to find someone who is experienced. I know that a lot of the challenges I had, Nick, when I got involved was going full cycle on a deal. Most
Yeah.
people who invest in multifamily want to know, okay, did you go full cycle? Did you buy? Did you do your strategy? Did you wind up selling? How many of those you did? So they can see, what the experience is. So if you are an investor out there, you definitely want to align yourself with someone who's full cycle, who's went through got the lumps over their head and went through all of that. So appreciate you coming on the show today.
Thanks for having me.
It's a great interview. Another great episode of PFREI, Passion for Real Estate Investors. Make sure you guys check us out on YouTube. If you see us there, please like and share. And you can catch us wherever you see other podcasts. Thanks for coming on the show today, man. I appreciate it.
Yeah, thanks for having me. It was great being here. I enjoyed the conversation.
Awesome.